Dan, I won't bury the lead. You say people are way too focused on the Fed. Why is that, Dan?
Yeah, I think, John, I mean, the Fed was the story of last year, right? The market was mispricing inflation, mispricing the Fed. I think a lot of that heavy lifting's been done. So, all those clips that you just played about the Fed being data dependent, I think we got to recognize that the Fed at this point is not in the driver's seat. The Fed is going to respond, to the macro data, and ultimately it's going to be growth. So if you think that growth is going to slow, that's going to determine what happens to rates, the Fed, earnings, et cetera. Conversely, if you're bullish on growth, you should think that rates are going to go higher. So I think that's going to be the ultimate driver of things. And we think, at least on the data we see now, that growth is going to slow.
Well, let's talk more about that data. I've said a few times we've had 2 years worth of narratives in 2 months, January and February. When you get to March 14th, that CPI print, and you get to 8:31 Eastern time, does that narrative switch back again?
It could. I don't think it's going to change in a big way. I mean, I think that, the market is intensely focused on sort of what the Fed has outlined as their focus, which is sort of services, non-ex shelter. And I think it doesn't look like you're going to see any big change there. So I think, we have to recognize that inflation has shifted from, the leading volatile components now to the lagging sticky components. And the fact that they're sticky and lagging means that they're probably going to be with us for a while, and you're not going to see a dramatic fall off anytime soon, especially with the labor market as tight as it is. So I think, that's not going to be a big game changer in my mind.